AAR Corp just dropped their Q4 fiscal 2026 numbers. And right off the bat, because our source stack today is strictly the company's internal earnings presentation and the press release, we actually don't have Wall Street's consensus estimates or the aftermarket stock reaction to compare against.
Right, so we're just flying blind on the market reaction for a second.
Exactly. We're just looking at the raw data they put out. But here's exactly what they reported for Q4. Revenue is $928 million, which is up to 23% on a GAAP basis.
And, you know, for anyone rusty on the accounting side, GAAP just means generally accepted accounting principles. It's the strict, standardized way to report numbers without any management spin.
Right, no funny business. But the company did note that their total adjusted sales were actually up 26%, and adjusted earnings per share came in at $1.53, which is a massive 32% jump.
Wow. Yeah, 32% is huge.
Right. Adjusted EBITDA hit $116 million, expanding their margins to 12.5%. And then looking ahead, which is always what the market really cares about, for Q1 fiscal 27 guidance, management expects 21 to 23% sales growth. And that is explicitly excluding their legacy commercial programs.
Yeah, and we really have to look at those quarterly numbers as the capstone of a massive full fiscal year 2026 performance.
Totally.
Because if you zoom out, we're talking about $3.3 billion in total sales for the year. That's up 19%. And an adjusted EPS of $5.05, which is up 29%.
It's just massive volume.
It is. But what really stands out to me when you comb through this presentation is that this isn't just a one-off, lucky year driven by post-pandemic travel surges or whatever.
Right.
This is clearly the result of a very deliberate multi-year strategy. I mean, management is claiming a 37% compound annual growth rate in adjusted EBITDA over the last 5 years.
Over 5 years. That's insane.
Yeah. In the industrial aviation space, where you are dealing with heavy machinery, massive physical facilities, and highly unionized labor, that kind of sustained profitability growth is just incredibly difficult to achieve. It really points to a fundamental structural shift in how this company is operating.
Exactly. And that is exactly our mission for this deep dive today. We are going to tear down this earnings report segment by segment for you, the retail investor. We really need to analyze exactly how their core pillars like parts, repairs, and this surprising new software angle are driving this top-line growth.
Right. The software thing is fascinating.
It really is. But more importantly, we're going to look under the hood to identify the risks that might be hiding in the margins. Because let's be honest, top-line revenue doesn't mean much if it's just bleeding out on the bottom line.
Yeah, which is the perfect lens to view this whole thing through. Because AAR is in the middle of a massive portfolio optimization right now. They are actively shedding low-margin contracts to build a much more durable cash-generating platform.
Right, so let's start with the biggest piece of the pie. Imagine being the exclusive gatekeeper for the critical parts that keep the world's most popular commercial jets from becoming, billion-dollar paperweights on the tarmac.
It's a pretty good spot to be in.
It's an incredible moat, and that is exactly what AAR is trying to build. This brings us to the biggest driver of their top-line growth, which is the parts supply segment.
Right.
So Q4 parts supply sales came in at $423.8 million. That is a massive jump from $305.5 million just a year ago.
Yeah, that's wild.
We're looking at 39% total growth, with their new parts distribution organic growth sitting at a very healthy 19%.
And what's really fascinating here is how they are actually achieving that organic growth.
Yeah.
Because it's not just a general uptick in aviation traffic.
Oh, no, definitely not.
It is highly strategic, locked-in partnerships. The major catalyst from the report that we really have to highlight is this multi-year exclusive distribution agreement they signed with Woodward.
Right, the Woodward deal.
Because of this deal, AAR is now the exclusive distributor for high-demand consumable parts on the CFM LEAP, the GeneX, and the CF34 engines.
Okay, let's unpack this and ground it in reality for a second. Because those specific engines, they are the absolute workhorses of the global commercial fleet. I mean, the AAP engine, for example, is what powers the Boeing 737 MAX and the Airbus A320neo families.
Right. The planes everybody flies on.
Exactly. Every single day. So by securing exclusive distribution rights for those consumables, AAR is essentially making itself a toll booth on the only highway out of town.
That's a great way to put it.
It's like they're trying to be the Amazon Prime of aviation aftermarket consumables.
Right.
If an airline needs a specific fuel nozzle or a critical sensor to keep a 737 from sitting idle, they have to go through AAR. But here's where I want to push back on the strategy a bit.
Okay, let's hear it.
When you are moving that kind of massive volume and acting as a middleman distributor, usually you have to sacrifice price to win the exclusive contract from the manufacturer, right? Like, with such high volume, are they actually maintaining their profitability? Or is this 39% growth just a top-line vanity metric that looks really good on a press release?
No, I mean, it is a totally valid concern. And traditional distribution, say, auto parts or retail electronics margins just get squeezed to death because it's a constant race to the bottom on price.
Exactly.
But the data from AAR's report actually tells a different story.
Mm-hmm.
If you look at the segment's adjusted operating margin, it currently sits at a very healthy 13.3%.
Wow. Okay.
Right. That proves they aren't just moving volume for the sake of volume, they're moving higher margin offerings. The Woodward deal isn't just about moving cheap bolts and screws, It is about highly engineered critical components where AAR has immense pricing power.
And I guess that's because the airline's alternative is a grounded aircraft?
Exactly. A grounded 737 costs an airline thousands of dollars a minute in cascading delays, passenger compensation, lost revenue. It's a nightmare. That cost is infinitely more than paying AAR a premium on a critical consumable part.
Yeah, that makes a lot of sense when you put it in those terms. The switching cost for the airline is basically non-existent because they literally have no other choice. And the cost of failure is just astronomical.
Right.
But selling physical parts clearly isn't enough for AAR anymore. They are taking those parts, servicing them, and wrapping the whole physical ecosystem in software. So let's pivot and look at their second major segment: repair, engineering, and software, or RE&S.
Yeah, this is where we see their whole connected platform strategy really coming to life.
Yeah.
Management doesn't just want to sell you the part in a cardboard box. They want to install it on your aircraft, maintain it over its life cycle, and track the whole thing digitally.
And the numbers definitely reflect that massive ambition. The RE&S segment reported $314.4 million in sales, which is up 35% year over year. Yeah, they had record sales in component MRO, which, for anyone unfamiliar, stands for maintenance, repair, and overhaul. Their facility in Wellington, Kansas, actually just won the Collins Aerospace Supplier of the Year award, which is a huge industry stamp of approval for quality control.
It really is.
They also saw organic volume growth in airframe MRO, including inducting the very first aircraft at their brand new facility in Oklahoma City. Plus, we have the recent major acquisition of Asia Eco Americas, and in April, they acquired Aircraft Reconfig Technologies.
Actually, I want to pause on that Aircraft Reconfig Technologies acquisition for a second, because the report notes it added something called an FAA Designation Authorization, or ODA.
Okay, what does that actually mean?
So in plain English, that means the Federal Aviation Administration has essentially deputized AAR to perform certain safety approvals and engineering certifications on behalf of the agency itself.
Wait, really? So they don't have to wait for a government inspector to fly out and sign off on a repair design?
Exactly.
Yeah.
Normally, if an MRO facility has to design a custom repair for structural damage on a jet, they had to submit mountains of paperwork to the FAA and wait weeks, sometimes longer, for approval.
Oh, wow.
Yeah. But with an ODA in-house, AAR can sign off on it internally. For a repair and engineering business, having that ODA is a massive competitive moat. It severely cuts down the bureaucratic red tape. And remember what we just said about grounded aircraft.
Thousands of dollars a minute.
Right. If AAR can get a jet back in the sky 5 days faster than a competitor because they don't have to wait on the FAA, airlines will gladly pay a massive premium for that speed.
That is a brilliant point regarding turnaround time. And what is really jumping out to me is how they are pairing that physical efficiency on the hangar floor with a serious software push.
Oh, yeah.
The earnings presentation notes that their track software has expanded at Delta Airlines, surpassing 10,000 users. Plus, they just launched Airvoyant, which they describe as an AI-powered procurement solution to connect buyers directly to suppliers.
And you really have to look at how that perfectly complements their parts supply business.
How so?
Well, if you control the digital procurement platform that the airlines are logging into to find parts, and you also happen to be the exclusive distributor of the most critical engine parts.
Oh, I see it.
Yeah, you can see how the ecosystem starts to feed itself. The software funnels the customer right back to AAR's own physical inventory.
I see the vision, but here is the catch. And this is where I need you to translate the financials for us, because the math is telling two different stories right now.
Okay, shoot.
Despite this massive 35% revenue growth in RE&S and all this talk of software moats and FAA deputizations, the segment's adjusted operating margin actually dropped.
Right.
It went from 10.4% in Q4 of fiscal 25 down to 10.0% in Q4 of fiscal 26. So I have to challenge this strategy. So what does this all mean? Are they simply buying revenue at the expense of profitability by gobbling up massive operations like HAE Co?
What's fascinating here is that it's the most important question to ask when a company is highly acquisitive. But in this specific case, the margin compression wasn't a surprise. It was entirely expected by management and baked into the strategy. The drop is primarily due to the HAE Co. Americas acquisition.
I have to stop you there because literally every management team claims a margin drop is expected after an acquisition. They always blame integration. What proof do we actually have from the report that this isn't just a bad, overpriced purchase dragging down the core business?
That's a totally fair level of skepticism. But let's look at the mechanics of buying a company like HAE Co. When you buy a massive, complex physical operation with multiple hangars and thousands of employees, there are immediate heavy integration costs.
Right.
You have to harmonize IT systems, retrain staff to your standards, and often upgrade their physical facilities. The target company almost always operates at a lower margin profile than your core optimized business initially. The report explicitly states that HAE Co. was a known short-term drag, diluting the Q4 segment margins by about 130 basis points.
Okay, so in plain English, a 1.3% drag on the segment's overall margin. So if we back out that 130 basis points, the core organic RE&S business is actually expanding its margins.
Precisely. The core business is actually getting more profitable. And the really good news for investors looking at the data is that management noted the HAE Co. integration is actually running ahead of schedule.
Oh, that's huge.
Yeah. They expect HAE Co. to be fully integrated and brought up to AAR's margin standards by the second half of fiscal year 2027. Once those operational synergies are fully realized, meaning the IT is unified, the labor force is trained, and the supply chains are merged, that 130 basis point drag should evaporate, unlocking significant future margin expansion for the entire segment. It is basically a short-term penalty for a long-term strategic asset.
Okay, that paints a much clearer picture of the commercial side. But buying up tech companies and massive airframe facilities isn't free. And AAR also has a massive footprint in the defense sector. The dynamics there are totally different, and it really shows how a shift in program mix can radically alter profitability.
Oh, completely. The government contracting world is a completely different beast compared to commercial aviation. It is often characterized by massive long-term contracts, but the margins can be highly variable depending on exactly what services you are providing.
Right, and the numbers for Q4 are a perfect example of that weird dynamic. Government Solutions sales actually declined. They dropped to $130.2 million from $141.5 million a year ago. Management attributed this entirely to the decline in their WAS program.
And for those unfamiliar with the government acronyms, WAS stands for Worldwide Aviation Support Services.
Got it.
Think of it as providing the logistics, maintenance, and fleet support for government agencies in some of the most austere, remote, and difficult environments on the planet.
Right, so revenue is down, but,
Yep.
and this is the crazy part, the adjusted operating margin for the government segment skyrocketed. It jumped by 620 basis points, going from 8.2% to 14.4%.
It is the ultimate real-world example of why chasing top-line revenue can be a total trap.
Truly. And despite the revenue drop, they still secured a massive win to restock the pipeline. A 5-year, $305 million follow-on contract to continue providing logistics support for the U.S. Navy and Marine Corps C-48 fleet.
That's a great win.
Yeah. But the most important strategic update in this entire earnings report relates to a structural change. Management announced a new reporting structure and stated their explicit intention to wind down their legacy commercial programs business, or LCP.
This is a huge signal to the market about how disciplined this management team has become regarding capital allocation.
Right, but for a retail investor, this can look incredibly confusing. You have a government segment losing top-line revenue but printing wildly higher margins, and now management is intentionally shutting down an entire segment of their commercial business.
It sounds counterintuitive.
Exactly. Can you walk us through the actual business reality of why dropping the LCP segment and accepting lower government revenue makes sense for someone looking at the long-term value of this stock?
I absolutely can. It all comes down to where you choose to deploy your capital and your workers. In the past, companies in this space would chase any revenue they could find just to make the top line look bigger for Wall Street. but not all revenue is created equal.
Right.
The WASTA program they are winding down and the legacy commercial programs they're exiting were likely highly capital-intensive, low-margin operations.
What does that mean practically, like on the hangar floor?
Think about turning wrenches on a legacy commercial program, meaning older generation, out-of-production aircraft. Sourcing parts for a 30-year-old airframe is a logistical nightmare.
Oh, I bet.
The work is slow, it's highly manual, and the airlines aren't willing to pay top dollar because they're phasing those old planes out anyway. The profit margins are razor thin. By intentionally shedding those contracts, AAR loses some vanity revenue, yes.
But they gain something else.
Exactly. They free up cash, highly skilled union labor, and precious physical hangar space to focus entirely on higher margin, high growth cash flow generators.
So what exactly are they replacing that legacy work with? Like, what goes into that freed up hangar space?
Well, the report specifically highlights growth and margin expansion in their mobility systems, which is driven by pallet shipments.
Pallet shipments.
Yeah. That is highly specialized, proprietary logistics work for the military. Designing and manufacturing specialized pallets that allow the military to rapidly deploy heavy equipment out of cargo planes carries a much higher margin than struggling to find a replacement part for a 30-year-old commercial jet.
That makes total sense.
By shedding the leaky buckets in their portfolio, AAR is proving to investors that they care more about generating profitable, free cash flow than they do about hitting an arbitrary revenue target.
That makes total sense when you break down the actual work being done. And speaking of cash flow, all of this growth, the M&A activity like HAO and aircraft reconfig technologies and the strategic maneuvering, it all requires capital.
A lot of it.
Right. If they are intentionally shrinking revenue in some areas to boost margins, we have to ask how they are paying for all this growth. Let's look at their balance sheet health and, more importantly, the looming risks. How are they funding this platform and what could realistically derail it?
Well, a pristine balance sheet is the only thing that allows a company to execute a transformation of this scale. If they were choked by debt, they wouldn't have been able to make these strategic acquisitions, invest in AI software, or wait out the margin dilution from HAECO.
Looking at the numbers, they seem remarkably healthy. Net debt sits at $816 million. Their net leverage ratio is at 2.03x. Management has a stated target leverage range of 2.0x to 2.5x, so they're sitting perfectly at the very bottom end of their target.
Which is exactly where you want to be.
Right, so just to translate that, their debt is only roughly double their annual cash earnings, which in the capital-intensive industrial world is incredibly manageable. And their cash generation is solid too. Adjusted operating cash flow was $58 million in Q4 and $94 million for the full fiscal year Term 6.
That cash flow figure is the engine of the whole machine. The report notes that adjusted cash from operations as a percent of adjusted EBITDA was 50% for the fourth quarter.
Okay, that's impressive.
Yeah, they are efficiently converting their operating profit on paper into actual usable cash in the bank, which is what allows them to pay down the debt they took on for these acquisitions so quickly.
Here's where it gets really interesting to me. AAR has successfully digested major acquisitions recently. HAECO Americas, ADI, aircraft reconfig technologies, and yet they've managed to keep their leverage incredibly lean at that 2.03x mark.
It's a tough balancing act.
They aren't over-leveraged. That means they have the dry powder to either make another strategic acquisition or weather an economic downturn without breaching their debt covenants.
It's an impressive feat of financial engineering, no doubt.
Yeah.
But if we connect this to the bigger picture, we really have to look at the forward-looking risks management explicitly outlined. Building an airplane while you are flying it is not without its turbulence.
So what are the primary threats that could eat into that pristine cash flow? Like, what keeps management up at night?
Management listed several in their forward-looking statements, but a few stand out as critical for retail investors to monitor. First, they operate in a highly regulated environment, particularly with the government, where they rely heavily on fixed-price contracts.
Let's walk through the economics of that. A fixed price contract is great when inflation is zero and supply chains are perfect, but it is an absolute nightmare if your costs suddenly spike rapidly.
Exactly. Let's say you sign that $305 million contract with the Navy to service the C-48 fleet for a fixed price over 5 years. You model out your expected costs in 2026.
Right, you lock it in.
But if suddenly in 2027 the cost of raw materials like titanium spikes, or you have to raise the wages of your skilled mechanics by 20% just to retain them, the Navy does not pay you a single dollar more. AAR has to eat that difference. Cost overruns on those fixed-price contracts can obliterate your margins overnight. Secondly, they specifically noted the risk of integration failures and the need to manage their operational footprint. We just talked about them opening a massive new facility in Oklahoma City, and the report notes inductions for a Miami airframe MRO expansion began in Q2.
So we are talking about facility execution risk.
Yes, standing up new physical infrastructure requires highly skilled personnel, specifically airframe and power plant mechanics, or A&P mechanics.
Right.
If there is a shortage of skilled aviation mechanics, which, by the way, is a widely known systemic issue across the entire aviation industry right now, or if there are work stoppages or supply chain hiccups at those new facilities, they just won't be able to turn those aircraft around fast enough.
And that backs up the whole line.
Exactly. In the MRO business, hangar space is a perishable asset. If a plane is sitting in your hangar for 30 days instead of 15 because you don't have enough mechanics to work on it, it backs up your entire system. You can't induct the next paying customer, and profitability plummets.
Wow, yeah.
Add in the ever-present threat of cyber disruptions to their new digital platforms and general commercial aviation fluctuations. And you realize exactly why this lean balance sheet is absolutely necessary to absorb potential shocks.
That is a fantastic, sobering counterweight to the massive top-line growth numbers. It really highlights why management's ruthless focus on margins and free cash flow is the right play in a volatile environment. So, to bring it all together and recap the core thesis for you, the retail investor based on today's report, AAR Core is successfully executing a connected platform approach.
Right.
They aren't just a physical parts distributor anymore. They are integrating parts distribution, airframe repair, and digital software into a single ecosystem. They are highly disciplined, intentionally shedding low-margin legacy commercial programs to focus on high-margin cash flow in both the commercial and government sectors. And despite the short-term noise of M&A margin dilution from HAECO, they are guiding for strong double-digit growth of 21 to 23% in Q1 of fiscal 27.
It is a textbook example of a company transitioning from a legacy industrial model to a modern integrated services platform. But this raises an important question, and it's something I really want to leave you to mull over as you analyze AAR's future trajectory.
Let's hear it.
We spent some time unpacking the mechanics of their software, pushed the expansion of Trax at Delta, the launch of Airvoyant for AI procurement, and the rollout of their paperless hangar technology in Oklahoma City and Greensboro.
Right.
Historically, AAR has always been valued by the market as a physical, wrench-turning, parts-moving industrial business. Those businesses get lower valuation multiples because they're highly capital-intensive. But as these digital tools scale, the marginal cost of adding a new user to a software platform is virtually zero.
That's very true.
So could AAR's software division ultimately evolve into a high-margin, recurring revenue mode that eventually outshines the profitability of their physical businesses? If the market starts valuing them even partially as an aviation software company rather than just an industrial MRO, the upside multiple could look very different in the years to come.
Now that is a truly fascinating angle to end on, because Wall Street loves a high-margin tech multiple a lot more than an industrial services multiple. It is definitely the key narrative to watch as Airvoyant and Trax continue to roll out across the industry. And that is all the time we have for today's analysis. Remember to follow the show for daily earnings coverage so you can always stay one step ahead of the markets. Keep digging into the numbers, and we will catch you on the next deep dive.